The headline price is the distraction, because the real stress is showing up in how metals are getting financed, hedged, and delivered, and the people who pretend essing just another risk-on week are about to get clipped by the exact mechanism they keep ignoring. Stay with me, because in a few minutes, I'm going to give you the one-week checklist, the level that changes the math, and the hidden signal that tells you whether this volatility is a shakeout or the front edge of something far bigger. Gold just proved it can print a fresh record and then snap back like it hit a trap door, and silver is acting like it's allergic to calm. That's not random. That's the structure. That's positioning. That's confidence leaving the building in slow motion, and volatility stepping in to collect the fee. And here's the uncomfortable truth. When confidence drops, markets don't announce it with a press release. They do it by charging you more for liquidity, widening the spread between the story and the settlement, and turning reasonable risk management into forced behavior. And that's where the real pressure starts. Let's get the price context clean, because without it, the rest sounds like noise. Gold recently pushed into record territory, one of those prints that makes people sit up straight, screens light up, and every casual observer suddenly feels like they need an opinion. But the same market that handed out that record also yanked it back, fast. Not a gentle drift, a snap, a reminder that the path matters more than the destination. When a market does that, when it runs and then slaps, your first job is not to guess the next headline. Your first job is to ask who was forced to do what. Because price is not just information, price is a weapon. And in a high volatility regime, it's a weapon that gets used against the people who chase, panic, or size too big. But that's not the part that matters. The part that matters is why the snap happened right after the record, and why the next move is likely to be faster than your instincts want it to be. Here is what the mainstream keeps missing. It is not just the level of gold and silver that is changing. It's the cost of insurance on that level. It's the implied volatility. It's the premium market participants' demand to take the other side of your urgency. When implied volatility rises, it's not just traders getting nervous. It's the market repricing the probability distribution of outcomes. Translation: bigger daily ranges become normal, not exceptional. And once that happens, everyone who manages risk, dealers, funds, miners, refiners, ETFs, even end users, starts behaving differently. They shorten time horizons. They hedge differently. They demand more collateral. They widen bid-ask spreads. They reduce size. Liquidity thins, not because people disappear, but because people stop offering generous prices. And that is how you get a market that can touch a record and then whip around like it is trying to throw riders off. Because it is. Now let's talk about confidence drops, because people hear that phrase and think it means vibes, politics, social media, drama. No. Confidence in markets is plumbing. Confidence is collateral. Confidence is whether the marginal buyer believes the rules won't change mid-game. Confidence is whether the market believes the currency, the bond market, and the policy narrative are stable enough that you don't need to reach for hard assets. And when that confidence starts wobbling, even slightly, precious metals don't just rise because people feel poetic. They rise because the system reprices trust. But here's the conflict. There are always powerful incentives to downplay that repricing. Institutions don't like panic narratives. Funds don't like admitting they're late. Commentators don't like explaining market structure when a single headline is easier. So you get a chorus that says it's just profit-taking, or it's just a strong dollar week, or it's just geopolitics, or it's just whatever. But this move isn't emotion, it's math. And the math shows up in the mechanics the cameras don't cover, because if this one mechanism tightens, the whole setup flips. Here's the hidden detail, the one that reframes the entire story. Physical demand is telling a different story depending on where you look, and that divergence matters more than any single spot print. In some regions, premiums have surged, meaning buyers are paying above the reference price to actually secure metal. In other regions, demand gets choked by price levels or local currency strain, so the activity looks soft on the surface. That split is not a contradiction. It's a map. It's how stress travels through the real world. And in metals, the most important thing is not what a chart says in isolation. It's whether the paper price is being validated by the physical market, or whether the physical market is quietly vetoing the paper narrative through premiums, availability, and the urgency of sourcing. Because the second that physical tightness forces the paper market to respect it, price discovery changes character. The next detail is what flips the whole setup. So let's make this simple and finance real. When people say gold price, they usually mean a reference price, often discovered in highly liquid paper markets, futures, swaps, forwards, ETFs, options. The paper market is incredibly efficient at translating macro narratives into ticks, but physical metal is not paper. Physical metal has location, fabrication, purity, logistics, refining capacity, delivery timing, and inventory constraints. Physical is slower, but it's also stubborn. And the tension between paper and physical doesn't always show up as a dramatic shortage headline. It shows up as subtle frictions. A premium here, a borrowing cost there, a spread that refuses to relax, a delivery schedule that suddenly matters, a scramble for the right bar in the right place at the right time. And when volatility rises, those frictions get louder. Because participants who were comfortable rolling exposure or carrying hedges suddenly have to make choices. Choices cost money, and that cost bleeds into price. Now zoom in on the calendar. Because in precious metals, time is a catalyst. There are delivery windows, there are contract cycles, there are option expiries, there are month-end and quarter-end positioning needs. There are reporting dates that force funds to show a certain posture. There are inventory decisions that get made on a schedule, not on your feelings. And when volatility rises into these windows, the market's behavior changes. This is not abstract. If you have exposure through futures, your contract has rules. If you're short, you can't just be kind of short. You have margin requirements. You have potential delivery obligations depending on how you manage your book. If you're long, you may need to roll exposure, and rolling in a stressed environment can become expensive. If you're a dealer who sold options, you have hedging flows that accelerate when price moves into certain zones. And if you're a fund manager who doesn't want to explain a drawdown, you may cut risk at the worst possible moment. This is where volatility becomes reflexive, and that's where the real pressure starts. Let's talk about reflexivity through options, because this is one of the cleanest explanations for why markets suddenly feel like they were moving on rails and then snapping. Options dealers manage risk dynamically. When they sell options, calls, puts, they don't just sit there and pray, they hedge, and the sensitivity of an option's price to the underlying delta changes as the underlying moves. That change rate is gamma. When gamma is high, small moves in the underlying force larger hedging adjustments, and those hedging adjustments can amplify the move. In plain English, if positioning is right, the market can create its own momentum, not because everyone suddenly became more bullish, but because risk management forces participants to buy as price rises or sell as price falls. That can turn a clean breakout into a surge and a pullback into a waterfall. And here's why it matters this week. In a rising volatility regime, the market becomes more sensitive to these flows. The same move that used to be manageable now triggers a cascade, because if this one level breaks, the math changes. Now fold in the other mechanism that makes precious metals uniquely spicy, the difference between deliverable and non-deliverable inventory. This is where people get fooled by headlines like inventories are up or vault holdings increased. The key is not just total inventory, it's what's actually available to satisfy delivery, what's in the right form, what can be moved without friction, and what holders are willing to part with at current terms. A vault can hold metal that is technically there but effectively locked, allocated to long-term holders, earmarked, or not economic to mobilize quickly. When stress rises, available shrinks faster than total. And that's when spreads start to talk. That's when premiums widen. That's when lease rates, borrowing costs, and immediate delivery pricing signals become more informative than a headline spot chart. But that's not the part that matters. The part that matters is that these signals often lead the next spot move, not follow it. So let's stack proof, because you don't build trust by shouting one narrative. You build it by showing multiple independent signals pointing in the same direction. First proof point, the recent record and snapback itself. Markets don't behave like that when participation is smooth and confidence is stable. They behave like that when liquidity is thinner, positioning is sensitive, and everyone's staring at the same levels. Second proof point, the divergence in physical premiums by region. When one major region is paying up to secure metal while another region is constrained by local affordability, that's not demand is gone. That's demand is migrating. That's the marginal buyer is changing, and that changes the floor under the market. Third proof point, vault behavior and stored metal trends. When holdings rise or at least remain firm into a high-profile move, it suggests the market is not simply dumping metal into the rally. It suggests hoarding behavior, precautionary allocation, or at minimum, a reluctance to part with metal at paper terms. Fourth proof point, institutional vehicles and flows. When ETFs and similar products see renewed interest, it's not just a retail story. It's often portfolio construction, people paying for diversification when correlations feel unstable, and those vehicles, depending on structure, can influence physical sourcing and futures demand. Fifth proof point, central bank behavior. Central banks don't chase candles. They accumulate strategically, often quietly, and that demand can be persistent in a way that short-term traders underestimate. The sixth proof point is silver's character right now. Silver is not just a monetary metal. It's an industrial input with supply chain realities. When it moves violently, it's often signaling a tug of war between macro hedging behavior and industrial procurement behavior. And hybrid assets are the ones that whip the hardest when regimes shift. The next detail is what flips the whole setup. Now, if you're thinking, Okay, but how does that become volatility? Here's the mechanism in one clean line. Higher uncertainty increases the price of protection. Higher protection costs force hedging behavior. Hedging behavior moves the market. And that market movement validates the higher uncertainty. That loop is reflexive, and it gets supercharged around the calendar. When you get close to contract roll periods, delivery notices, and option expiries, the market's microstructure matters more than macro speeches. Even if the long-term story is bullish, the short-term path can get violent because positioning has to be managed through these windows. And when confidence is already dropping, participants are less willing to give the market room. They cut faster, they hedge tighter, they make the market feel like it's jumping between floors. Here's a quick calculation-style intuition that will save you money. In a low volatility regime, the market can absorb a certain amount of buying or selling without huge price impact because liquidity providers are comfortable leaning into flow. In a high volatility regime, the same amount of flow causes a larger move because liquidity providers step back, spreads widen, and depth disappears. It's not that there are no buyers or sellers, it's that the price they demand to engage becomes worse. That is why you can see a record print and then a sharp pullback without any new information. The information was the flow itself. The market was telling you participation is brittle, and brittle markets are where the cleanest trends and the nastiest traps coexist. But that's not the part that matters. The part that matters is what the market is likely to do next, and how to tell a thesis from a tantrum. Let's talk counterpoints before we get to the roadmap, because credibility requires it. Precious metals can drop hard even when the bigger thesis is correct. Why? Because metals rallies can become crowded quickly. Because profit-taking after records is real. Because funds will de-risk into volatility spikes. Because a single shift in yield expectations can spark short-term pressure. Because the dollar can rip in a way that temporarily squeezes commodities. Because geopolitical headlines can fade as quickly as they appear. And because when the market gives you a big move, it also gives you a reason to doubt it. That doubt is how it extracts pain. So don't let anyone sell you the fantasy that up only exists. That's not how real markets work. And if you need one sentence to tattoo on your brain, price can whip around violently even if the thesis is correct. The question is whether the underlying structural signals hold while price whips. Because if they do, the whip is not a warning, it's a mechanism. Now we build the viewer psychology shield because this is where most people get farmed. Volatility manipulates you by compressing time. It makes every tick feel like a verdict. It turns I have a thesis into I need relief. It makes you anchor to the last price instead of the structure. It triggers the exact sequence that market makers love. Chase the breakout late, panic on the first pullback, sell into a liquidity pocket, then watch the market bounce without you. And in metals, that emotional cycle is especially brutal because narratives are loud. 1 hour it's inflation, the next hour it's rates, the next hour it's geopolitics, then it's risk on, then it's risk off. The narrative is a carousel. The mechanism is the ride. Your job is not to win the narrative contest. Your job is to survive the ride with your decision-making intact. Here's how. Separate trend signal from noise. Trend signal is what the market does around key levels. And through key calendar windows, while structural indicators, premiums, spreads, hedging costs, institutional behavior, remain supportive. Noise is the intraday whip that happens because liquidity thins and positioning is nervous. One forces long-term decisions. The other tries to force emotional decisions. The next detail is what flips the whole setup. So what do you actually watch right now, today, this week? Start with the obvious level that everyone sees because that ESS where the market turns into a mirror. Gold recently traded around the mid 4,600 zone after tagging a record area and snapping back. Whether it holds that broad region matters, not because the number is magic, but because of what it forces participants to do. If gold can stabilize above the area where it snapped back, especially if it does it while volatility stops expanding, then the move looks like a controlled retest. The market is digesting, not breaking. If gold slices below that zone and can't reclaim it quickly, that S, when you get the more painful version of the pullback, liquidation and hedging flows feeding each other. And silver? Silver ES behavior around its recent extreme zone matters even more because silver is the one that tends to overshoot in both directions. If silver can hold key supports after violent swings, it signals that industrial and monetary demand are still in the fight. If silver loses those supports and starts trending lower while gold remains resilient, it tells you silver is being treated as a risk asset, at least temporarily, and the market is de-risking. But that's not the part that matters. The part that matters is the confirmation signals behind the chart. Confirmation signal 1, implied volatility behavior. You don't need a fancy terminal to understand the concept. If price is moving up while the cost of protection stays bid or rises, that means the market is not relaxing. It's paying for uncertainty. That's bullish in a tense way because it suggests participants expect larger moves and are willing to pay for it. Confirmation signal 2, physical premiums and retail availability. If premiums remain firm even during pullbacks, that's a sign the physical bid is not just chasing price. It's strategic. If premiums collapse during pullbacks, that's a warning that the physical market is stepping back. Confirmation signal 3, spreads and immediacy. Watch for signs that near-term pricing is tight relative to later pricing, or that financing conditions are changing. You're not looking for perfection. You're looking for whether the market is paying extra for now. Because when a market pays extra for now, it's telling you confidence is slipping and urgency is rising. Confirmation signal 4, ETF flow tone and institutional posture. Again, you don't need to obsess over daily numbers. You're looking for whether institutions treat pullbacks as entries or exits. Confirmation signal 5, central bank tone and reserve behavior. If structural buyers remain present, dips can be shallower than people expect. And here's the kicker. The more volatility shakes weak hands out, the more the remaining holders are the ones least likely to sell. That's when moves can accelerate. Because if this one level breaks, the math changes. Now let's lay out the 2-scenario roadmap, because this is where you turn urgency into clarity. Scenario 1 is the controlled pullback and retest. In this scenario, gold pulls back from record territory, tests the support band around the recent consolidation zone, and then grinds higher. Volatility may remain elevated, but it stops expanding aggressively. Pullbacks get bought, not because everyone is euphoric, but because hedgers and longer horizon allocators see value in exposure when confidence is wobbling elsewhere. In this scenario, the market is building a base for a later leg higher, and the biggest risk to you is not being wrong, it's being shaken out. The confirmation is simple. Price stabilizes after pullbacks. Rebounds occur on decent participation, and the structural signals, premiums, hedging costs, institutional tone, don't break. The invalidation for this scenario is also simple. A decisive breakdown below key support that fails to reclaim quickly, combined with a visible relaxation in physical tightness and a drop in the cost of protection. That would tell you the market is not just digesting, it's repricing. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the market doesn't give everyone a comfortable retest. It holds the higher zone, volatility stays bid, and a catalyst, often calendar related, forces participants to chase. That catalyst could be an options-related flow where dealers have to buy as price rises. It could be a delivery window that tightens the immediate market. It could be month-end positioning where funds pas T want to be underweight, the thing that S working. It could be a sudden currency stress episode that makes trust feel expensive. In this scenario, the move is not smooth. It's jumpy. It can gap. It can run when you think it should rest. And it can punish anyone who's underhedged or overconfident. The confirmation is a market that refuses to dip meaningfully, that keeps snapping back, and that maintains urgency signals in the background. The invalidation is a sharp breakdown that turns into sustained weakness and a clear unwind in volatility. But here's the practical takeaway that keeps you sane. Both scenarios can be bullish over a longer horizon, but they feel completely different in the short term. One invites patience, the other demands respect. The next detail is what flips the whole setup. So what is the why now trigger? It's the calendar meeting the regime. We're in a moment where contract cycles, delivery considerations, and options positioning can matter more than your favorite macro thread. When the market approaches periods where participants roll exposure or manage delivery-related risk, small frictions become big. When month-end approaches, funds care about what they report and how their risk looks on paper. When implied volatility is already elevated, those calendar pressures can amplify moves. And if confidence is dropping, if the market is uneasy about policy credibility, rate paths, or broader institutional stability, then precious metals become the arena where that unease expresses itself. Not because everyone has a bunker fantasy, but because the market is repricing what it considers safe. And safe is not a feeling, it's a balance sheet decision. Let's bring silver back into the frame, because silver is where a lot of people get trapped by the wrong mental model. Silver isn't a pure safe haven, it's a hybrid. It has monetary characteristics, yes, but it also lives inside real industrial demand chains. And industrial demand doesn't politely pause because volatility is high. It adapts, it front runs, it hedges, it shifts procurement timing. In high volatility regimes, industrial buyers and sellers can inadvertently contribute to reflexive behavior. Suppliers hedge, users secure forward needs, traders position around liquidity pockets. That can make silver look unhinged, but it's not unhinged. It's stressed. And stress doesn't move in a straight line. It moves in bursts with air pockets, which means your risk management matters more than your prediction. That's not the part that matters. Now, the part that matters is how you stay aligned with the bigger signal without letting the short-term violence own you. Here's the cleanest way to think about risk in this environment without getting paralyzed. Size and time horizon are your superpowers. If you're treating a volatile metal market like a slow index fund, you'll get emotionally ambushed. If you're treating a structural shift like a day trade, you'll get chopped. The solution isn't be smarter. The solution is to match your position size and time frame to the volatility regime. In a high volatility regime, smaller positions held with conviction beat bigger positions held with fear, because fear forces bad timing. And bad timing is what volatility is designed to extract. Build a plan with an invalidation. Decide what would prove you wrong. Decide what would prove you right. Then let the market do what it does without making you rewrite your identity every hour. Now let's anchor this in a concrete what to watch next list, but in narrative form, so it sticks. Watch how gold behaves around the zone it snapped back to after the record. Watch whether pullbacks are shallow and quickly reclaimed, or deep and sticky. Watch whether volatility stays elevated, because a market that stays expensive to insure is a market that expects more movement. Watch regional physical signals, premiums, availability chatter, and whether the physical market seems to be resisting the paper mood swings. Watch silver's relationship to gold. Is silver confirming the move with resilience or diverging like a stressed risk asset? Watch the dollar and real rate narrative, but don't let it hypnotize you. Sometimes metals can rise even when those variables are not supposed to allow it, precisely because confidence is the variable that isn't on the dashboard. And watch the calendar. Option expiries, contract roll periods, and month-end behavior, because those are the moments when forced flows can matter more than opinions. Because if this one level breaks, the math changes. Here's the final quiet warning that separates seasoned operators from headline surfers. Volatility will be used against you. If you're right, the market will still try to make you feel wrong before it pays you. It will run without you, then dip just enough to make you chase, then drop just enough to make you panic, then bounce the moment you capitulate. That's not a conspiracy, that's incentives. Liquidity gets sourced from emotion. The market doesn't need to know you personally. It just needs to know that most participants react the same way under stress. Your edge is refusing to be most participants. So where do we land? Precious metals are flashing a very specific message right now. Volatility is rising because the market is repricing confidence and the stress is showing up in the mechanics. Insurance costs, physical signals, calendar pressure, and risk management flows, not just in the headline price. Gold's ability to print records and snap back is a feature of a brittle, sensitive market, not a sign the story is over. Silver ASS violent behavior is consistent with a hybrid asset being yanked by macro fear and industrial reality at the same time. The near-term path can be brutal, but the structural signals can remain intact, even through brutal swings. That's why your job isn't to predict every tick. Your job is to watch the signals that actually change behavior. Key support and reclaim levels, implied volatility tone, physical premiums, and immediacy pricing, and calendar-driven flow pressure. And then operate with a plan that respects two scenarios: the controlled retest that shakes out weak hands, or the continuation squeeze that punishes hesitation and creates gap risk. Both can happen without warning. Both can exist inside the same month. The difference is what confirms and what invalidates, and whether the background signals stay tight while the foreground price gets violent. And if you want a subtle CTA that doesn't feel like begging, here it is. Don't watch this market alone through the funhouse mirror of headlines. Watch it with a checklist. Watch it with people who care about mechanics, not vibes. If you are the kind of investor who wants to understand what forces participants to do, what turns volatility from chaos into information, then you are in the right place. Because the next week or two is going to reward discipline more than brilliance, and punish certainty more than ignorance. Keep your eyes on the real price of immediacy. Keep your risk sized to survive the shake, and remember, in precious metals, the market can lie with the headline price, but it rarely lies with the spread, the premium, and the cost of insurance.